Good afternoon. Welcome to today's Business and Update webinar. I'm Aaron Blank, and I'm the moderator of today's webinar from the Theory Group. We'll be hearing today from Emons Holmquist and Hamilton Gardner of Holmquist and Gardner, a Seattle-based law firm with a focus on helping business and those in both the commercial and residential real estate space with all of their needs. During today's session, Emons and Hamilton are going to provide an update on what business owners and leaders should know about the impacts of what is COVID-19 on our business community. Additionally, our guest panelist today is Harold Speer. He's a shareholder at Hellam Varon. He'll help us dive into the world of business taxation, transactions, and succession planning, all the fun stuff that we all as business owners want to get into. And before I turn it over to Hamilton, I'm going to remind you all that you've tuned in today. If you have any questions through the dialogue today, there's a webinar tool, just like in every other Zoom webinar, you'll have an opportunity to answer and ask questions throughout the program. With that, I'm going to turn it over to Hamilton to give us the latest updates on some of the government orders. Hamilton?
Thanks, Aaron. I'm happy to be here and back on the webinar with Emons, and really excited to have Harold with us here today. I'm going to be brief because we really want to jump into what Harold's saying and what he has to provide today. But the big thing with the statewide moratorium ban is that Governor Inslee recently extended it to December 31st. Speaking specifically to commercial tenants, it relates to increases in rent and threats for evictions. So statewide, of course, that is going to be extended through December 31st. As it relates to King County, they have their own separate ordinance. And just as a reminder, this requires a reasonable repayment plan for commercial tenants and any non-payment issues related to COVID between March 1st, 2020 and March 1st, 2021. It requires the landlords to provide reasonable payment plan opportunities in writing. And if the tenant refuses or fails to comply with the reasonable rent repayment plan, it can be an option to proceed with the eviction. The other one relates to the city of Seattle. Again, all of these were in the last webinar and just wanted to recap them. There is the Seattle Ordinance 126116, which removes personal liability for small business owners, which renders personal liability clauses and guarantees unenforceable. Commences March 1st through 2020 and through 6 months after the expiration of all extensions of the eviction moratorium. Qualifying tenants are small businesses which have 50 employees or less, and there's a few other qualifiers as well. But again, if you are having any sort of issues as a landlord or a tenant and you are facing non-payment due to a COVID-related issue, make sure to call an attorney and walk through your scenario with them, because these moratoriums are changing and evolving rapidly, and you want to make sure that you know your rights. And just as on the landlord side, I just want to end by saying that there is a huge amount of administrative burden on for affidavits to proceed with an eviction or proceed with a collection effort, and you're having to get approval from the Attorney General before proceeding down this path. It takes a significantly longer time than it used to even a year ago. So with that being said, I'm going to pass it back to Aaron and over to Emons so we can move on with Harold.
Yeah, thank you. Appreciate it. It's always good to hear sort of the latest and what's going on in the community on things that we need to know related to real estate. So appreciate that. Emons, now over to you.
Thanks, Aaron. Thanks, Hamilton. Super excited to have Harold Speer with us today. Again, 22-year veteran as a CPA, and the last 15 years with Hellam Varon, primarily advising closely held businesses and their taxation issues. Had the great pleasure of working with Harold on a number of transactions over the years. Just a great guy, knows his stuff, so super excited to get right into it. Thanks, Harold, for joining us today.
You bet, absolutely. I'm excited. Let's jump in.
So, as always, we like to start with kind of a who's who in the zoo and what's going on. So maybe walk us through some of the trends sort of in the CPA world right now heading into Q4 2020.
You bet. It seems like everything that I'm getting, a lot of the questions center around one of two items. Got people asking about the Paycheck protection program loans that a lot of businesses took, and now we're starting the forgiveness process. And then also the election and what's going to happen with the tax world, and are there things that I need to be doing at this point in time to get prepared? And that seems to be a lot of the questions that we're fielding right now. So.
Yeah, so let's start with elections. So I kind of like looking at that in two buckets. One is, what are the typical election cycle things? Because every time there's an election cycle, we talk about certain things. And then what's different for this year? So why don't you sort of tackle those in two buckets so we can get an appreciation for those?
Yeah, you bet. So what we end up with now is kind of taking a look at what we think will happen. And I think what's important to look at too is after an election, it takes a considerable amount of time for a new administration to be able to enact tax laws. It's not something that happens just straight out of the gate. So you end up with some time to absorb it, to ask questions, to talk to your advisors, and find out really what it is that you think you may want to do. So, for example, even after Trump had been elected last time, tax cuts and tax administration changes were really of topic, and it took the better part of a year for those rules to be passed before anything came into play. So we end up with a little bit of a runway even after the administration. So I think that's something that's important to note, that even though I'm getting a lot of questions about what do we do, how should we be dealing with these things, but just to take just a minute, wait to see what happens, and just kind of feel the air in the sails a little bit before you start making changes and making course. So I think that just holding back is a bit prudent. So
sounds very sound and reasonable. So then taking us through this year, which I think,
Yep.
Who knows what's going to happen. Neither of us want to make predictions, but there's a number of things that we can talk about if there was a shift. Kind of key out there, something that we deal with a lot, are real property issues, specifically 1031s, and people are kind of waving in the wind, hey, are we looking at a possible scenario where were the Democrats to take control, 1031s would no longer be a thing? What are your thoughts on that?
Well, I think it would be really administratively difficult to get rid of a 1031 exchange. I mean, they have been in our tax code in some form for nearly 100 years, right? So, and then on top of that, with the struggles that commercial real estate is having and the issues that they're facing right now, to be able to remove such an important provision as 1031 is, to be able to shift and to move that away, that I think would be really difficult to swallow. So I don't believe that anything will happen with the 1031 exchanges, at least not right away. So there are reasons why tax law is put in place, and it's put in place to encourage certain types of behaviors, including the ability of people to invest in their communities and areas. So they don't necessarily want to remove that and have people taking their money from commercial real estate and extracting them and leaving communities sort of out. So I don't think that we'll see anything on pace with the 1031 exchanges. So if there is a change in administration, though, one thing that Biden has said pretty consistently throughout his campaign is, to make taxes more equitable and more fair, kind of all the way across the income earnings and the population. So he said repeatedly that he intends to reinstate the top federal income tax rate, which is currently at 37%, to push that back up to 39.6%, where it had sat for some time, a number of years for individuals. He's also talked about changing the corporate tax rate, which had dropped down to 21% under the Trump changes, moving that back up to about 28% as well. And then he's had other plans too for looking at capital gains and capital gains taxes. And I think that it's important for us to look at just history. So I've been practicing 22 years, and at one point capital gains were taxed up to 28%. And now they're taxed as low as 15% for long-term gains. So we're at a historically a low point in capital gains taxation. So, but what we may see, and one of the things that Biden has proposed is for taxpayers that have taxable income over $400,000, which is where he will institute that top tax rate of 39.6% again, to treat capital gains and tax them just like they were other ordinary income. So we'll see a change perhaps from 15% of capital gains tax all the way up to 39.6% as well. So I think that's going to be an important and impactful change.
Yeah, absolutely. And obviously this goes back to taking a time between now and whatever change happens. Your point about normal election cycles really applies here. There's no need to jump real quickly, but it seems like given there's normally a time gap between the enactment of these things and any change in office.
Exactly. I mean, just some time to chat with your advisors, talk to your investment advisors, your CPAs, your attorneys, and just make sure that you have a good, sound, logical place or plan in place. You wouldn't want to do something purely for tax purposes that harms you financially down the road. So just take a breath, or take a couple breaths, and then talk to advisors and enact a plan.
The other two kind of biggies that we talked about were the possibility of a change in the lifetime exemption for estate planning and then gift tax increase. Maybe touch on those briefly.
Yeah, exactly. That's important to note that the tax cuts that occurred back in 2017 were temporary. So at the end of 2025, they will expire. So even if there's a change in administration or no change in administration, without some action, there's going to be a significant change in the estate tax. So right now, there's an estate tax exemption at the federal level of $11.4 million per person. So that means that you can pass away with $11.4 million of assets and not pay a dime in estate tax to the government. So, and that amount is pretty high now. Prior to the passage of this act, it was 5 million. And even if nothing happens and items just are allowed to lapse, then we'll revert back to 5 million. It gets adjusted a little bit for inflation, so it may be somewhere between 6 and 7 million, even if nothing happens. So, looking at that over a long period of time, I mean, that's a pretty healthy amount of a difference between $11.5 million to even at a high end $7 million of what you can pass away with without having to pay tax. One really important part of that is that the IRS had said that even if that estate tax limit drops from 11.4 million down to 5 million or lower, they have no intent to claw back prior gifts that have been made. So if you're inclined to gift over the next several years, you have a pretty strong incentive to do that now while we still have this $11.4 million exemption amount. So if you intend to gift, perhaps you start talking about getting together with your estate planning attorneys, your CPAs, and starting to put together this plan of gifting so that you can do it in an efficient manner. So that's one thing that I wouldn't necessarily wait too long for. If you intend to gift, go for it.
Awesome. This is hugely helpful. We get these questions all the time, and it's just, again, this is why you talk to a tax advisor like Harold. Make sure you're totally on point with making your decisions regarding real estate and business investments. So those are great trends and certainly what's on our minds. Another one that we're all talking about is what's going to happen with these PPP loans. Banks are starting to get out their applications for forgiveness. Maybe walk us through kind of what you think is going to happen with that and how the taxation issues might affect us.
Yeah, that's really interesting to see what's going on in this world. So the PPPs came about as part of the CARES Act that was passed in March, and that act was put together so quickly from a historical standpoint. I mean, it was something that was drafted, passed within a matter of weeks, and for something that sizable, that was really impactful. And a major part of that CARES Act was the Paycheck Protection Program. And effectively what this is was a place where businesses could come, they could take a loan out through their bank via the SBA and use that loan for payroll, for some other purposes, for rent and various other items. And then if they used the Paycheck Protection Program loan for the purposes that they were supposed to have, then after the period that was originally 8 weeks and now got pushed out to 24 weeks, then they could go back to their bank. The banks would have an application that they would fill out, and businesses could apply for forgiveness of this loan. And under the CARES Act, that forgiveness was not taxable income. And that's really important because in tax rules, if you have a loan and that loan is forgiven or you don't pay it back, then that historically and traditionally would result in taxable income to you. So just insult to injury as kind of a matter of course. So what happened though is and only the way that an IRS or the Treasury can look at something is Congress was very specific in drafting the CARES Act that forgiveness of these PPP loans was not going to be taxable income. So the IRS took that and they flipped it over and said, well, okay, the income is not taxable. So therefore, what we're going to do is we're not going to allow you a deduction for these expenses that you claimed against the PPP loans, which has the effect of resulting in the same thing, right? So you're still going to have taxable income. So really what we're recommending, we're talking to all of our clients now about their PPP loans is when to apply for forgiveness. So the way that the rules currently work is that once you apply for forgiveness and are granted for forgiveness, then in that year you don't, if it's in 2020, you won't be able to take a tax deduction for those expenses that you used the PPP funds for. So your income and your business is going to rise. And maybe that's okay. Talk to the advisors and see if you have had a year in 2020 where absorbing some additional income is not a bad thing. Or if you think it's going to be material and you think 2021, maybe just in kind of the same year as 2020 was, well, maybe you wanted to defer that a little bit, see what Congress does. Right now, there are bills in both the House and Senate to try to rectify with the IRS exactly what Congress's intent was to not make that fund or funds from the PPP taxable. So, so kind of sitting and waiting is okay. And you have up to 10 months after the covered period, so after that 24-week period, if that's what you choose, before you have to seek forgiveness. So there's a long period of time to wait and see what happens with Congress, what happens with the applications. I mean, this is a real fluid process. I mean, even the process to seek the PPP, to seek the forgiveness, it's changing rapidly. One thing that happened recently was that there was a simplified form. So if you took less than $50,000 of PPP funding, then you don't have to go through the significant forms of reporting all the payroll, all the different items to seek the forgiveness. This form is almost like an easy tax form. It's you providing a couple payroll reports and saying, I used the money as I was supposed to, grant me forgiveness. And it's designed to be just a streamlined process for small taxpayers.
Yeah, that's extremely helpful. I want to echo your amazement at the volume of this project. That we've all done a lot of deals with the SBA over the years, and we can all say they're not known for their efficiency or expediency. And here they got these applications processed quickly and actually dispersed money very quickly. And now on the back end, it looks like they're working to make things a little more efficient, which is great to see. Another thing I just note about this whole PPP loan situation is we stress that banking relationships really matter, and having one bank that you work with often is a thing. And some people do that. Some people like to rotate around. I think we saw that the strong banking relationships really carried the day with how quickly the process went. And there were some surprises in that. And some of the big banks didn't act as quickly, but still got it done. But the key thing was that it's really important now, maybe more than ever, to have a real strong relationship with your banker.
Amen. I mean, I think that was critical in the process, and it was astonishing to see how those relationships were able to work. Just having a good banking relationship, a good loan officer that you could reach out to and have them return calls. I mean, bankers just were overwhelmed with this program, and it was astonishing the volume of it and how fast things were going. We had a banker refer to this program as a $800 billion food fight. I mean, it was something just a mad scramble for this, and the bankers played just a really key role in that. So thank your banker if you haven't recently. So they've been under a lot of pressure, one, to issue the PPP loans, and then now they're facing a second at bat with the loan forgiveness. So they've had just a heck of a year with a lot of these processing. So thank you, Chris.
So yeah, definitely we thanked ours. Let's move into some issues that we've seen in other areas, that changes in the last few years, just so people out there can kind kind of reflect on stuff, particularly with regard to the LLC stuff. We do a lot of investment LLCs, both just normal businesses and real estate. And I was hoping you could walk us through some of the changes the last couple of years in case people missed those.
Yeah, no, exactly. There, from an IRS perspective, there's been just a monumental change in how the IRS looks at and deals with partnerships or LLCs. Years ago, they had this process for auditing partnerships called TEFRA, and because of this, not a lot of partnerships actually got audited because it was really an administrative hassle for the IRS to audit them. They would go through, they would make adjustments at the partnership level. And then what they would actually have to do is to administer them to each and every partner, which was just an absolute hassle. I mean, you've got partnerships that may have hundreds of partners, and for the IRS to go through and apply that at each one was really a challenge. So what happened was a few years ago, the rules changed to where there's now something called a Centralized Partnership Audit Regime, or CPAR. And really what this is the partnership then becomes liable for the changes that happen under an audit. So not the individual partners. So it made it administratively easier for the IRS to audit partnerships. There's a new person or a new administration that the IRS looks to help them during this audit. And a partnership has something called a partnership representative. And this is very different than what they used to have as a tax matters partner. So there's now a partnership representative. And this partnership representative is a really powerful person for the partnership in front of the IRS. This partnership representative can bind the partnership and all of the partners to a decision with the IRS. So this is something where for that audit, the buck stops with the partnership representative. If you are a minority partner in a partnership that's being audited, and you don't like the decision that's been made by the partnership representative, you don't have recourse with the IRS any longer. You are bound to that determination. So this is something where a partnership representative can be designated each year, and it's designated on the tax return that's filed. But it was a really important change that was made a couple of years ago.
That's key, and I think you need to look back your operating agreement, and if you need to, this would be a time to amend your operating agreement, or at least have a resolution out there stating that if you've designated a tax matters partner, that should be interpreted to actually designate a partnership representative instead. So now, where does this go? Take us through, the other change that we've kind of seen out there is this entity selection process to get to the qualified small business stocks. And what the benefits of that?
Yeah, exactly. So this qualified small business stock, we'll shorten it to a QSBS. And what this is, so as we talked earlier about capital gains rates, going from 15% maybe up to 39.6%. Well, how does a 0% rate sound?
That sounds great.
Awesome, right? Yeah. So that's something you might be able to get from a qualified small business stock as drafted currently. What this is a qualified small business is something that it's a business that was formed as a C corporation, a domestic U.S. C corporation, and there was less than net of $50 million worth of assets in the corporation. So this is not really small lemonade stand type businesses. These can be a reasonably sized business, and as long as you've held that stock for 5 years or more, you can sell the stock in the QSBS and not have to pay tax on up to $10 million worth of the gain from the sale, or up to 10 times of your basis in the investment, whichever is greater. So that can be a considerable amount of gain that you pay 0% tax on. So, administratively, what we find is if you believe that you have invested in something that qualifies for a qualified small business stock, get a certification and get it quickly. It becomes administratively difficult if you're 10, 20 years down the road and this business is selling, you're transitioning it, you're doing something, and you think it qualified for small business treatment, but now you've gone through 10 different controllers or CFOs during that process and trying to find someone who had the information originally and is willing to signify that this was qualified small business stock can be difficult. So if you believe it qualifies, get a certification right up front to state that this is intending to qualify for small business stock.
That is huge. Thanks for outlining that, and it wasn't something that was on my radar when we were chatting yesterday. So that's why we
Yeah, and you know, and what's also important is that this was something that it was a company that was founded as a C corporation, and if it changes, so perhaps down the road elects a status or something else, then that stock can still carry over. So also something important to note. But ask advisors, get that certification if you can, because that rate is great. It's hard to beat 0%.
Yeah, and this plays into entity selection and startups and just making sure that you're getting solid advice on the way in, so you don't miss out on those kinds of opportunities. So before we open up to the audience for questions, I'd like to sort of conclude our presentation segment on what, some predictions you have heading into sort of Q4, Q1 2021.
God, it's interesting. So I've been in practice for 22 years, and for 21 of those 22 years, I probably could have given you a reasonable projection. This year, who knows, man? There's very few things that I'd be surprised. The year that we've had, I don't know. We look at the federal policy and all the stimulus funding that's passed in. I mean, I think rates are over some term are going to have to increase. We'll see that happen at some point, but. The way it's been so far this year, I wouldn't be surprised if it didn't. So it's just been a really unique period. So
fair enough. I can accept that. That I'm in the same boat, but I don't have any expertise in taxation. So with that, I think it'd be good to open this up to Q&A. I know our audience has some questions. I've seen some come in, and so why don't we let Aaron sort of moderate us through these questions?
Yeah, good discussion, guys. I got a bunch of questions myself as a business owner, as you can imagine. But before I get into any of mine, one out there is: do you see any success in the Main Street lending program, or is it too prohibitive? Too many hurdles for small businesses?
What's been interesting is just how we talked earlier about the struggle with the SBA and just the volume of applications they were getting. So when the CARES Act was passed, just the volume that they were seeing of people trying to apply for both these economic injury disaster loans, for the PPP, for all the different items, they were just overrun. But what we're finding is now that things are kind of getting back to more of a normalization again. So if for whatever reason you went through the first part of these loans and were just struggling either through the EIDL loans or the Main Street lending program and just didn't have much success, try it again. Go through this process again. I think the SBA has hit more of a normalcy point. So which is good. I mean, the volume that they were dealing with initially were just beyond excessive. So. I think that's now sort of settling out a little bit.
Okay. The golden question: S Corp or C Corp? What's your recommendation? And don't just say it depends on your situation.
I was going to say yes. Talking to your advisors, talk to your lawyers, talk to your accountants. There can be good reasons for being C corporations. There can be good reasons for being S corporations. From tax reasons, non-tax reasons, depending upon what you intend to do with your company. I've had a number of clients. I shouldn't say a number. I've had some clients that have transitioned when the tax law changed from a S corp to a C corporation. And it wasn't just for current income tax benefits. We looked at that over a long period of time and what their plans were for the companies. So it's not something you want to make in a vacuum. And if you do change, you generally are stuck with that change for a 5-year period of time. So it's not something that you can hop back and forth between years, just depending upon how you think your year is going to be. So if it's something you do, you want to do it for a meaningful reason. I
was setting you up there because the immediate question that came through, and before I even saw this question, it's related to that and that initial question. So question from Kim: does the qualified small business stock option only apply to C Corps? So that's the first question. The second to that is, if buying a building this year, would you recommend forming a C Corp to take title or convert to an S Corp or a C Corp in there? So it's kind of the follow-on on that first one.
Yeah, so the first part of that, so to qualify for that qualified small business stock, QSBS stock, the company has to be formed as a domestic C corporation. So that part's important. It can change structure later, but the formation has to be as a domestic C corporation. And to hold real estate, there's all kinds of reasons to have different structures, but I will tell you that corporations tend to be crab traps, right? They're really easy to get into, but difficult to get out of, right? So if you have a partnership or if you have a corporation that holds real estate, it's easy to form, easy to put the property in that corporation, but to extract it, to get it out, becomes a little more painful. So take a look at those two, talk to advisors about partnerships or LLCs, tax-just partnerships, and there can be some tax incentives for operating that way if it's something that you're able to do.
So another question came through is, and this is probably an open-ended question to anyone. Most lenders are reluctant right now on refinancing even profitable real estate these days to lower interest rates. With these incredible, unprecedented interest rates, do we see any of that changing anytime soon?
I think the product varies. So I don't know that they're reluctant if it's just a performing asset and it's clear that it's going to be a block over tackle performing asset. So your high rises and things like that, where a lot of the leases are very long term, are one thing, and smaller assets are different. So it seems to me like there's no question that if you have some interest in refining and it's looking like there's a pathway right now and that makes economic sense, you need to go now before we're at historically low interest rates. So that's kind of stating the obvious. But I wouldn't say that there's a huge reluctance out there to refi. I'm still seeing loans happen right now. You probably need to look around if you're getting a lot of pushback.
I'd just make a comment that, I've seen some reluctance, but to Iman's point, it depends on the product. In the multifamily world, which is the landlord-tenant world, you're gonna be hard pressed to find a lender right now just because of the uncertainty. Lenders like certainty, and so in multifamilies, that's going to be a difficult one to lend on. We know of some major lenders that were big players in the Seattle market that's just completely backed out of multifamily. But if you're talking about industrial, warehouse space, that's a different product. Or to Iman's point, high rises, another different product, or personal houses, again, different product. So I think it just depends on what type of building and the tenants and the occupants that you have in it, which is going to change a lender's appetite. But really, it's going to come down to certainty. In the multifamily world, I don't see that changing until the government gets a handle on the landlord-tenant laws and what they're going to do with the eviction moratoriums, which in terms of like a prediction that Iman's was asking earlier, our current prediction is that nothing is going to change until at least the spring at the earliest on the landlord-tenant side of things. So that's our prediction.
When you talk about the CARES Act, you guys, Harold, you talked a bit about this. Are there any tax items within the CARES Act that we absolutely need to be paying attention to that is coming out? It's still, as you said, the plane was 10,000 feet when they started handing out cash on that, and people might have been making deals in that. Are there things that we should be aware of as we proceed this year and or start paying back things like PPP?
Yeah, Aaron, that's a great question, and thank you. I was kind of thinking earlier about something else in the CARES Act that hadn't yet touched on. So another big piece that passed with the CARES Act was a correction that they made. When the tax cuts happened in 2017, they were also done very quickly. So there was not a lot of I's dotted or T's crossed, and it led to a couple really unfortunate things. One of which was prior to the 2017 Act change, there was something called Qualified Improvement Property, or KIP. And so what this was for commercial buildings. If you renovated or improved the interior portion of these buildings, you might have qualified for treating those improvements as a 15-year property. And that's important because anything that has less than a 20-year life or property under tax rules is eligible for something called bonus depreciation, which right now is 100%. So what that means is that you could expense up to 100% of the cost of improvements that you had made for commercial property in the year that you put them in service. And that was incredible. But what happened with the tax changes in 2017, they missed a couple of references between the points. They clearly intended this to remain in the rules, but they didn't, and it was effectively a 2-year gap where this wasn't the case. Now, as part of this, the CARES Act went back and it retroactively changed those rules. So if you're a commercial building owner, commercial landlord, and you made improvements to the property over the last couple of years, you've got the ability to go back in 2018 or improvements that were made in 2019 and perhaps make those corrections and expense the cost of those items. So that can be a great period, a great time to do it. Also included in that is Congress looked and they realized that, well, there's going to be a number of people that will be eligible for this. So they took the period where if you have business losses, where previously those business losses were limited of your ability to deduct them, they got rid of that. So there's no longer limitations on being able to take business losses. Well, excuse me, there's no longer a per business limit on the amount of losses that you can claim. But if you have losses, you can take those now and you can carry them back 5 years in time. So you can take those all the way back to 2014, maybe 2013, and you can use the losses from or expenses from these years against income in earlier years and get refunds of taxes that you previously paid. So the intent of that process was to try to get funding into taxpayers' hands just to help them through this time. So if you're a commercial building owner, you made improvements, and you haven't talked to your accountant or other advisors about KIP, do so. Get them on the phone. It's not too late to make those changes, and you can prepare some amended returns to go back and get those funds. So that was another important part in the CARES Act. So thanks, Aaron. Yep, good question.
What should I be thinking about if we're considering starting a new business using a corporation and falling under qualified small business stock? I know we've danced around this, but this seems like one that someone just put up there.
Sure. Well, I mean, to qualify for that small business stock exception, you do have to start the business as a C corporation, and then you look at the operations of the business. So, C corporations pay their own tax, and they pay tax at a rate of 21%. But then, anytime funding comes out of that C corporation to the shareholders, it's either coming to them as a salary, which is taxed at ordinary income, or it's coming out as a dividend, which can be taxed at 15 to 20% under current rules. So you end up paying tax at perhaps a blended rate of maybe 41% or more. It may be time to change the structure of the business into a different format. So talk to the advisors and find out if this business was started as a C corporation, if it makes sense to convert it to an S corporation, or even an LLC, and there can be some tax costs to doing so. So just make sure that the structure that you're operating under makes sense over the long run. That makes a bit of sense.
Following up on our last question, does commercial landlord apply to multifamily residential buildings?
So these. Oh, I'm sorry, Hamilton. You look like you were going to jump in there.
I guess I just need a little bit more information as to what exactly the question was referencing. If it was referencing the eviction moratorium, which we touched on early on, then there's a residential side of that the moratorium's there. But if it has to do with the tax, I'll let Harold take that one.
Perfect. And really this improvement property, it can be a commercial property, or it could also be something you'd want to look at for, well, different rules can apply to multifamily, and we'll get into that in just a second. But this qualified improvement property are things you look at for commercial or non-residential buildings. If you have a multifamily building, then there are some other rules that can apply for changes that have been made. So looking at and talking to your CPAs about the improvements that were made and what type of improvements those were, if it was a betterment or an adaptation to use, or if it's just generally a repair of that property. So there were some changes that were made 7 or 8 years ago now about being able to deduct either the cost of improvements that were made to a multifamily or single family residences, rental residences. Or if you did have to capitalize and deduct those expenses over time, you've got the ability of perhaps claiming a deduction for the old asset that's no longer there.
Okay. All right. And the final question here, Harold, what happens if the rules change in 2021, but your business seeks and obtains forgiveness in 2020?
Great question. So if the rules change in 2021 and you seek forgiveness in 2020, it depends on what the rules change. Quite often when rules change, if it's favorable to the taxpayers, then they're made retroactively. If it's unfavorable to the taxpayers, then the changes are made prospectively. So if you're a business and you seek forgiveness in 2020, and then Congress is able to pass very well specifically designed legislation, leaving the IRS no room for interpretation, then you generally have some time before you have to file your tax return in 2020, or your 2020 tax return in 2021. So it may be something where that before your return is filed in March or September, you've got a little bit of time to correct that. If they don't act and you seek forgiveness in 2020, and then you fall under the rules today. If rules change in 2021, it's likely that at some point they would make that retroactively if it was favorable, which may mean you're putting on an originally filed tax return or you're amending and correcting your 2020 tax return. So there's still hope if Congress can act.
All right, cool. So that's the end of this incredible good webinar. I know you guys at the law firm have done an incredible job at Holmquist and Gardner doing a bunch of these webinars this year. So appreciate all you guys have done for this. I want to thank everyone who joined in. If you have further questions, feel free to reach out to Emons or Hamilton to continue the conversation. They can be reached via email, emons@lawhg.net or hamiltonlawhg.net, or via phone at 206-438-9083. Keep an eye out for the next webinar, and the information around that will be posted on the Holmquist and Gardner website. We have Sydney Safley from the firm who will be hosting that in November. We appreciate everyone's time and we hope you have a great day. Thank you.
Thank you.